Okay, let's dive in. SoFi just dropped their latest earnings, and the headline is Huge E. They're absolutely crushing it.
Yeah, profitability is soaring, and get this, they're actually raising their financial forecast for the year.
Exactly. So for you, the learner, if you want to cut through all the financial noise and really get what's happening with SoFi, you are definitely in the right place.
Think of this as your fast track, your shortcut to the key insights.
Welcome. Today, we are taking a deep dive into SoFi Technologies' first quarter of 2025 earnings analysis.
We've got the detailed breakdown. We'll look at the management spin and really unpack what these numbers actually tell us about their strategy and, well, their future.
Right. Our deep dive today is built right on the SoFi earnings report analysis. It's this really comprehensive look at their financial performance, segment breakdowns, key metrics, future guidance, the whole package.
And our mission here, for you, the learner, is pretty straightforward. Extract the most important insights, explain the jargon in, plain English, highlight those aha moments.
And leave you feeling well-informed, maybe even a little ahead of the curve.
Exactly. We'll break down the key chapters of this analysis to give you a really clear picture. Let's kick things off with what they call the executive snapshot.
Chapter 1, Executive Snapshot. So, right out of the gate, SoFi started 2025 incredibly strong. We're talking a record-breaking quarter.
Yeah, they exceeded analyst expectations for both revenue, the money coming in, and earnings, their profit.
And this is big. It's their 6th consecutive quarter of GAAP profitability.
That's really significant. There used to be investor concerns about whether they could consistently make money, actual profit on the books. This addresses that head on.
Definitely. So what's powering this? The report highlights financial services and fee-based revenue as the key growth areas.
Let's get into some specifics. Record-adjusted net revenue, $770.7 million. That's up 33% compared to last year.
And listen to this. The growth rate itself is accelerating. It's the fastest they've grown in 5 quarters. That feels important.
It really suggests their strategies are gaining momentum, not just ticking along. And that flowed through to profit. Record-adjusted EBITDA hit $210.3 million.
Which is up 46% year over year, right? With a solid 27% margin.
Exactly. And GAAP net income, that's the standard accounting profit, was $71.1 million, or 0.06 pence per share.
Record-adjusted EPS also hit 0 to 6 cents. Just records across the board, it seems.
And member growth, too. 800,000 new members, another record.
Plus 1.2 million product additions, so members are signing up for more things.
That's the cross-selling piece, but this number really stands out. Fee-based revenue surged to $315.4 million.
That's a 67% jump year over year.
Yeah, and it signals that shift towards what they call capital-light income. Less reliant on just making loans. More stable, arguably.
Makes sense. And reflecting that confidence, they raised their full-year 2025 guidance.
They upped expectations for adjusted net revenue, adjusted EBITDA, and GAAP net income and EPS.
Which is interesting because, a lot of their peers are being pretty cautious right now, given the whole macro uncertainty thing.
Right. Raising guidance now suggests management feels their specific strategy, the FSPL, that's the Financial Services Productivity Loop, is working and provides some insulation.
So, bottom line for this chapter, the integrated strategy and the pivot to diversified fee-driven revenue seem to be paying off big time. Okay, let's move to Chapter 2, results versus expectations.
Right. How did these numbers stack up against what the Wall Street analysts were predicting?
Let's hit those headline figures again. GAAP net revenue, $771.8 million, up 20% year over year.
But the adjusted net revenue at $770.7 million, up 33%, that really shows the acceleration we talked about.
And that 6th straight profitable quarter gave them GAAP diluted EPS of 0.06 cents. Adjusted EPS also 0.06 cents, up 200% year over year. Huge jump.
Okay, now versus the expectations, the beat. Adjusted net revenue came in at $770.7 million. The consensus estimate was around $741 million.
So they beat that by almost 4%, a solid beat on revenue.
But the EPS beat was even bigger. Both GAAP and adjusted EPS were 0 and 2 cents. The consensus, just 0 and 3 cents.
Oh, they doubled it. 100% surprise on earnings.
Yeah. That really points to stronger than expected margin performance and just really good operational efficiency, running the business well.
And these kinds of beats, especially on earnings, can definitely be a positive catalyst for the stock price, right?
Often, yes. And importantly, this wasn't just a fluke quarter. We're seeing consistent growth.
Right, year over year. Adjusted net revenue up 33%, adjusted EBITDA up 46%, adjusted EPS soaring 200%.
And even compared to just the last quarter, Q4 2024, they're still growing. Adjusted revenue up 4.3%, adjusted EBITDA up 6.3%, adjusted EPS up 20%.
So steady growth quarter over quarter on top of strong year-over-year comparisons. It reinforces that idea of sustained momentum.
Exactly, effective execution. The report includes a table highlighting these beats, really emphasizing that accelerating adjusted revenue growth. It's a key positive signal.
Okay, let's shift to Chapter 3, Drivers and Management Highlights.
Yeah.
What did CEO Anthony Noto and the team actually say drove these results?
Well, the tone from management, especially Noto, was extremely positive. He called it a tremendous start to the year.
Yeah, I saw quotes like durable growth, strong returns, relentless focus. Sounds like they're feeling pretty good.
Very confident. The core themes seem to be maximizing that lifetime value, the LTV per member, through their whole ecosystem.
And that mission to help people get their money right?
Right. So what did they specifically point to as performance drivers? We mentioned the record member and product growth.
And that huge surge in fee-based revenue, the $315 million, up 67%. Where's that coming from?
It's a mix. Their loan platform business, where they connect loan buyers and sellers' origination fees on their own loans, interchange from debit cards, brokerage fees, referrals. It's diversified.
Got it. Plus strong growth in the financial services and technology platform segments combined.
Yeah, those two together saw net revenue jump 66% year over year, and continued deposit growth is key.
Because that lowers their funding costs, right?
Yeah,
Cheaper money to lend out.
exactly. Big advantage. They also saw loan originations pick up across personal, student, and home loans. Student loans had their best quarter since late 2021.
And importantly, credit performance is improving. Fewer defaults.
That's what they reported. Lower delinquency and charge-off rates. Plus, that loan platform business, or LPB, is expanding with new partners committing over $8 billion so far this year.
And just general brand awareness getting stronger. Lots of positives.
Definitely. Now, let's dig into that FSPL and diversification a bit more. The financial services productivity loop is really their cornerstone.
The idea is get a member in for one product, then get them to use checking, investing, loans, everything.
Precisely. And the numbers suggest it's working. Remember, 1.2 million product additions versus 800,000 member additions.
So on average, each new member is taking more than one product, or existing members are adding more. Successful cross-selling.
Exactly. And the diversification trend is clear. Financial services products were 90% of the product growth.
And the combined revenue from financial services and the tech platform is now over half their total adjusted net revenue.
Yep, 53%, up from 49% just last quarter. It shows that shift away from being just a lender.
They even launched that SoFi Plus subscription rate, fee-based.
Yeah, with strong early adoption and cross-sell rates reported. From an analysis standpoint, the FSPL maturing into a real value driver is huge. It supports higher LTV, more efficient customer acquisition.
And the diversification.
Crucial. Growing fee revenue in non-lending segments reduces capital intensity, lowers credit risk exposure. That could mean more stable returns, making them more attractive to investors long-term.
So it really is about building that whole financial ecosystem.
Oh,
Okay, let's look ahead. Chapter 4, Outlook and Key Metrics. What are they guiding for Q2 and the full year?
For Q2 2025, the guidance is adjusted net revenue between $785 million and $805 million.
Okay, so continued growth from Q1.
Yes, about 3% sequential growth at the midpoint. Adjusted EBITDA is guided between $200 million and $210 million.
That's a potentially slight dip from Q1's record EBITDA.
Correct. About a 2.5% sequential decrease at the midpoint. Could be seasonality, maybe some planned investments, or just a touch of conservatism in the near-term outlook. Margin might compress slightly in Q2.
But the big news was the raised full-year guidance. Let's recap those numbers.
Right. Full year 2025 adjusted net revenue now expected between $3.235 billion and $3.310 billion. That's up from the previous range.
Adjusted EBITDA also raised to $875 million to $895 million.
And significantly, GAAP net income guidance was boosted to $320 million to $330 million.
Which translates to GAAP EPS of 727 to 0.28 cents for the full year, also an increase.
They also guided for tangible book value growth of $585 million to $600 million and expect to add at least 2.8 million new members this year.
And how does this compare to what analysts were thinking before the report?
Well, the Q2 guidance midpoints were slightly ahead of the pre-earnings consensus, but the raised full-year guidance really blew past expectations.
Especially on the GAAP EPS, right? Living $0.27 then, so $0.28 versus maybe $0.25 as before.
Exactly. A significant beat on the full-year profit outlook.
So raising the outlook after just one strong quarter really shows management's confidence. What assumptions are likely baked into that?
You'd assume they expect continued strong member and product acquisition, ongoing loan demand, particularly for that LPB.
Stable or improving credit quality, good expense control.
The benefit of those low-cost deposits continuing, and, a relatively stable macro environment. It's a confident stance, especially compared to more cautious peers.
That contrast is interesting. It suggests SoFi feels its own execution and model provide some resilience, and boosting the GAAP net income guidance reinforces that move towards sustainable profitability and better operating leverage.
Yeah, it supports their longer-term EPS goals. Okay, let's bring it all together. Chapter 5, bottom line takeaways.
So recapping, a very strong Q1 performance, beating expectations, leading to a raised full-year outlook.
Profitability seems firmly established now, and that strategic shift towards a diversified, more capital-light model is clearly underway and working.
The growth engine is firing member ads, product ads, fueled by that FSPL strategy.
And that growing deposit base is a huge funding advantage. Can't overstate that.
Credit quality looks like it's improving, which is good news, but obviously something to keep watching closely as they grow loans.
Absolutely. So, key things to watch going forward. FSPL execution. Are they keeping that cross-sell momentum?
Growth and margins in the financial services segment specifically.
Credit performance trends, definitely. And simply, can they hit this raised guidance they've now set for themselves?
All right, final provocative thought for you, the learner. SoFi isn't just a lender anymore, right? They're building this whole financial ecosystem.
Yeah. So the question is, will this diversified approach, relying heavily on member deposits, make them a long-term winner in this crowded fintech space?
Could they genuinely disrupt traditional banking models? What part of their strategy do you find most compelling? Or maybe most concerning? Something to think about.
Thank you for joining us for this deep dive today.
And hey, if you want more in-depth financial analysis like this one, please subscribe to the Stock Analytics AI YouTube channel.
Just a reminder, the information discussed here is for general informational purposes only. It's definitely not financial advice. Investing involves risk, and past performance doesn't guarantee future results.
And please remember, any AI-generated content should be used critically as just one tool among many. Always do your own thorough, independent research before making any investment decisions.